Now let's talk about the cash payroll checking account. Most companies use a special checking account just for payroll. Obviously, it's an asset account, and it's usually called cash-payroll. Only payroll-related checks are written from this checking account. All other checks, such as to pay the utilities bill or rent expense, would come out of a separate cash account, usually called cash operating. So most companies have two checking accounts, cash operating and cash payroll. So why would we want to have a separate cash payroll account? Well, several reasons. Number one, it provides better internal control. Well, what's that mean? I'll give you two examples. Let's say an employee illegally changes the amount of their paycheck. Of course, this would be a pretty rare event. But if they did, they're going to change the amount of their paycheck to be higher than it was. Because they've increased the amount of their check, the cash payroll account would eventually go negative and the bank would alert you. Another example, and much more common, is sometimes employees just don't cash their paychecks. This causes problems for the accounting department and for the payroll people in particular, but it's easier to detect if there's a separate cash account just for payroll. Now, when I worked in payroll, a lot of our engineers just didn't cash a paycheck. They would stuff their paycheck in their drawer. We would have to go visit them and encourage them to cash their paycheck as soon as possible. Another reason to have a separate cash account is it's easier to reconcile your checking accounts. So at the end of every month, you're going to get a bank statement for all of your checking accounts, and you have to reconcile them. What this reconciliation process means is you're going to compare the bank statement to the transactions that occurred in that particular checking account. Now, if you split up your checking account so that there's one for cash operating, one for cash payroll, then each one will have fewer transactions and would make doing this monthly reconciliation much easier. So when we're using a cash payroll checking account, for each pay period, you're going to have to transfer some cash from cash operating to cash payroll. The transfer from regular checking, called cash operating, to the payroll checking account is made sometime between the completion of the payroll register and the date the checks are distributed. So on the next slide, we'll do a journal transaction to get some practice. So our goal here is to transfer funds from cash operating to cash payroll for the upcoming pay period. So on October 26th, the main checking account, called cash operating, has a balance of $100,000. The payroll specialist transfers $8,000 from cash operating to the payroll checking account. So now we're going to do the journal entry on the bottom of the screen. The first thing we need is a debit account. So which account is going to be the debit account? Well, both of them are asset accounts, cash operating and cash payroll. So if we're going to debit one of them, that means that account is going up. So which account is going up? Cash operating or cash payroll? Cash payroll is the account going up. And the A plus is reminding you that it's an asset going up. So we're going to debit that by $8,000. That means the cash operating account will be credited, it's an asset going down, by $8,000. Now I'm going to post the $8,000 debit to the cash payroll, and then we're going to post the $8,000 credit to cash operating. So that's the journal entry and the posting of transferring funds from cash operating to cash payroll.